Expected value and insurance. Here I'm going to explore expected value and its relationship with insurance. And in order to do so, I'm going to make some simplifying assumptions. First of all, I should mention that all these numbers I just made up, I hope they reflect the real world, but they are purely for illustrative purposes. First of all, suppose that there are just 10 people. And suppose they all have an identical distribution of losses. So these people, that is, face the exact same risk. Let X equal the losses that an individual will experience over the next month. And suppose that each distribution is given by, well, X could be a $5,000 loss with a probability of 3%. But X could also be a $0 loss, that is no loss, with a probability of 97%. Here I'm thinking about, for example, auto insurance. Most of the time when people have an auto insurance policy, months go by without them actually having any losses. They just pay for the auto insurance without experiencing losses. So for each person, the expected value is 5,000 times 0.03 plus 0 times 0.97. That works out to be $150 a month. So what I did was I had Microsoft Excel generate for me random values, random numbers, and I said, give me $5,000 with a probability of 0.03 and $0 otherwise. And here's what I came up with for 5 months for those 10 people. Now you might notice how there are just a couple of losses, and the average is $500 in those months and $0 in other months. Sometimes that could be higher than 500 if there's multiple losses, but notice how there is a dramatic variation in the average from month to month. Now here I have for 30 people, and here again you see most people experience no losses, but a few experience some losses, and the average goes up and down: 167, 0, 0, 333, and 500. Just seems like there's quite a bit of variation, but less so than for 10 people. Now here's the results for 400 people, so that I didn't fill the whole screen with things that are so small to read. I just edited out a lot of the middle people, although they are represented in the average. So the average for month 1 is 137.5, average for month 2, 125. Now you see things starting to cluster closer to the $150 expected value. Finally, I'd like to mention the results for 10,000 people. Now here the average is quite close actually to the 150. It is fairly stable across time: 141, 156, 135.5, etc. So here, once insurance policies cover a large group of people, if they're all similar people, then we could get a pretty stable result month to month, given that each month has the same expected losses. So the question then is, how much is a person going to have to pay for such an insurance policy? Well, the premiums are the cost of getting insurance. Premiums are just what you pay for insurance. So suppose that we have the expected value of the loss is $150 a month, and suppose that other costs, like administrative costs, for example, are another $50. So how much is an insurance company going to charge for this? Well, insurance companies want to charge as much as possible. They are for-profit enterprises. They are trying to get as much revenue as possible. They want to charge as much as possible. Now, a lot of people that don't understand much economics think that insurance companies and other companies could set their prices however they want. But suppose that this insurance company was to set their price at, say, $300. They want to charge $300 for this policy. Well, this policy, they'll get $300 a month, but the expected profit is $100 because their costs are only expected to be $200, 150 plus 50. Well, that's a lot of profit for every 300 for every policy. $100 in profit is a sweet deal for these insurance companies. That's a huge amount of profit. So what's going to happen is their competitors will come in and say, you know what? I could give the exact same policy, and I'm happy if I could just take your customers away from you, even if I just charge $250. And so they're still going to get $50 of profit, which is actually still a lot of profit for the policy. So competitors will then try to try to take customers away from them, and they will continue to drive down costs. So in a market economy, market competition will continue to drive down costs. Now the costs should not ever be lower than $200 though, because then insurance companies are making a loss for each policy. In that case, the insurers would probably just exit the market. They would rather not sell insurance at all than to sell it at a loss. So as with many other markets, in competitive markets, you would expect the premium to be close to the costs, and so just a little bit above $200.